What's up, guys? Welcome to this episode of the GrowingAU Show. Hope everyone's having a super highly successful day, and I appreciate you all joining us here today. So, as most of you have seemed to enjoy when we do those Motley Fool type reviews on the episode, we're going to be looking at another Motley Fool article today. We've all seen a very crazy market recently. I sound like a broken record because I keep repeating that, but despite that, we've seen a number of companies have a pretty decent rally over the last couple weeks. So for some investors, it may seem like there's only good days ahead. Well, despite that, there are a couple stocks you need to be avoiding. So instead of going over the top 5 stocks to be investing in, today we're actually going to be looking at the top 3 stocks you need to avoid if you enjoy having money. And these are listed all by the Motley Fool. The link to the full article by the Motley Fool will be below, but let's roll that intro and jump into the episode. So I will say, first off, if you haven't already, I would appreciate a like and a subscribe. Really helps us continue to support this channel. We just hit that 500 subscriber milestone, and I appreciate everyone that has made that possible. So let's move forward. Time is money. So the first company that the Motley Fool says you need to be avoiding if you enjoy your money is Whiting Petroleum. Whiting Petroleum, currently at a 0% buy rating from experts and at $1.50 per share, filed for bankruptcy on April 1st. And since that point, they've seen some relative volatility in their stock. Their stock jumping from 37 cents a share all the way up to $1.70 a share at one point and trading pretty near there since then. Those incredible jumps have brought a lot of attention to the stock recently by retail investors looking for a bargain. One of the main reasons this company's been doing so poorly is because of the hard hit in oil prices. We saw that about a month ago now, the really almost negative drop when it comes to oil storage at one point, and this company has had a hard time making it flow and had to end up filing for bankruptcy. So what's the plan for Whiting Petroleum investors? Should you be looking at this company? Well, here's why the Motley Fool says no. So under the bankruptcy plans, the company does plan to issue new stock post-bankruptcy. However, 97% of that stock is going to be sent to creditors, leaving only 3% stock left for us investors. There also are some warrants that will be set at an unspecified price that we do have the option of purchasing if we so wish. However, prices for the oil company's long-term bonds propose far lower prices as far as their shares are concerned moving into the future, which is really leading the Motley Fool saying, we don't want anything to do with this. Don't worry about buying the warrants. Don't worry about trying to get those quick fluctuations in their share prices. There's better places to be going. However, this next place is not necessarily one of those better places. Hertz. I'm sure you've been listening to Hertz. I'm sure you've heard it on the news if you pay attention to financial stuff. Hertz has gotten a lot of attention recently. The company, the car rental company, recently applying for bankruptcy on May 22nd. They dropped dramatically to 56 cents per share. They've jumped quite dramatically since then to $6.25 a share, now trading at about $1.50 a share with, again, a 0% buy rating from experts. The reason the company hurt so bad is that they fell in the wake of lower demand for car rental services due to the COVID outbreak. A lot of companies being hard hit. Now we're seeing the companies that were hard hit the most. So you might be thinking, so why are people going back and purchasing this? Well, shareholders believe that the full recovery of the car and truck prices could save Hertz. However, Motley Fool believes that is highly unlikely. Hertz kind of adopting an odd strategy here. They were going to issue $500 million worth of new stock to try and gain some value back into the company. However, they said that this stock probably would be worth nothing after the bankruptcy. However, that's not deterring would-be investors. Now, there is some recent news on that. Maybe that was last year heard that the company was going to be issuing those new shares. However, recently the company decided that nope, we are not going to be doing that. The reason for this is that because the company said themselves that the shares would probably be worthless, which really caused the SEC to start looking into the company. And as soon as that happened, Hertz wanted nothing to do with it and pulled the plug on that entire operation. As far as Motley Fool is concerned, Hertz is not a company you need anything to be doing with right now. There are better places to put your money and just to completely avoid them. Finally, moving on to the last company that Motley Fool says you need to avoid completely if you enjoy your money is a company that I actually owned at one point, Chesapeake Energy. Now, Chesapeake Energy, currently trading at $13.09 a share, has a 0% buy rating, again, from experts over at Morningstar.com. They are likely to file for bankruptcy relatively soon. The only company that has not yet filed for bankruptcy. In fact, by the time you're watching this video, it's going to be a couple days after it was recorded, so there's a good chance they've already filed for that bankruptcy. But despite that, the company and the stock has seen some relatively wild movement recently. Trading at $12 to $15 near the end of May. We can see how far that's dropped over the last 5 years. But they jumped to $70 on June 8th. They stayed there for a few days, and then on June 15th, dropped back to $19 a share. This crazy movement has caused, again, a lot of investors to be highly interested in the company, wondering if it's going to happen again. Chesapeake's rise in that time period came to, again, the rise in oil prices, but again, it just was not able to be sustained. I'll read this quote for you here. Chesapeake has already worked hard to sell off assets in an attempt to refinance refinance its outstanding debt. Conditions for such sales are horrible right now, closing off a key strategy for avoiding bankruptcy. So now they're talking about what's the bankruptcy filings going to mean for investors. Well, there is a possibility that a deal will leave investors with something. However, Motley Fool think that this deal is highly unlikely, meaning that after the bankruptcy filings and all that kind of turbulence is over, that investors are probably going to be left with nothing. And after all, that's one of the reasons that Motley Fool is saying, yeah, you want to get out now. Is it possible that Whiting, Hertz, and Chesapeake Energy could begin to rebound in the future? Yeah, it's possible. But as far as the Motley Fool is concerned, as far as I'm concerned, there's better places you can be putting your money. You don't need to worry about whether or not you can make a quick buck off of these shares. I think there's far better places that we could be going when it comes to our investing and our time when it comes to our research. So Hertz, Whiting Petroleum, Chesapeake Energy, I wish them the best. But as far as the Motley Fool and I am concerned, you as an investor could be going other places. Hope you enjoyed this video, guys. Definitely check the resources in the description for you, as well as the source to this article if you want to give it the full read. And with that, appreciate you watching, and we'll catch you next time.